It's not even going to be approaching my view until it hits 5,000. Otherwise, I'm just a windbag. But if we see 5,000, 5,500, 6,000, then you're going to say, that's what that guy was talking about.
That's what he was talking about. That's what he was talking about. Ladies and gentlemen, fellow asset capitalists, I don't know where I am. I don't know what I'm saying, but I do know that we have. Is he an enigma? George Robertson. It's certainly an honor, a pleasure, my desire. I find myself in the confines, luxury confines of St. Bart's, and every week I reach out, desperately seeking friendship and the titillation of a mind, of an intellectual tour de force. And again, I'm sure I've struck gold, if you will. I'm very pleased to say that I'm with George Robertson. Now, George has been everything. I mean, George, talk about the Caribbean, was a sailorman, and I'm riveted to hear the story of his adventures way back in schooners and ships and moving them around these phantom objects around the Mediterranean Sea, from the Caribbean Sea. Where am I? Back and forward with the US mainland. But more than that, and since 1981, he has been pursuing thrills as an arbitrageur, as a banker, as a hedge fund manager. But he's here to try and rub off some of his expertise in that essential dialogue between monetary policy, the economy, and the fixed income markets. It's all about today, people. And so, George, what a delight to have you.
Thanks for having me.
What are we going to discuss, George? I mean, given that your superpower is this dialogue between monetary policy, fixed income, and the economy, I can think of no one that I'd rather spend a Friday afternoon perusing the madness of the world. I mean, the other day I was on Bloomberg and I was saying, I was quoting Jim Morrison, when the music's over, when the trend is over. What have they done to our fair sister, George? They've ravaged, they've plundered our fair markets, our fair system of capitalism. What have they done, George? Tell me, what have they done?
Well, I think we're at a really critical point that's not too far from what happened. And I don't want to be too wonkish, but what happened in 1951, where the Fed and the Treasury had to sit down and figure out an accord in terms of what's the Fed's job, what's the Treasury's job, and so they wouldn't interfere with each other. The Treasury had to back off from ordering the Fed at that time to keep rates low. There's no need to fund World War II anymore. And the Fed had to manage this massive deficit that was the results of World War II, and especially the very large, completely rehypothetical fixed income treasuries. So it wasn't a major problem in terms of credit, but it was a huge job to manage and to proceed with any sort of monetary policy. At the same time, they didn't do a very good job, or at least certainly Congress didn't help them. And by the time we got into the 70s, we had to have the Humphrey-Hawkins Act. We had to have various other laws added to the Federal Reserve Act of 1913, such that they became more clear in terms of exactly what the Fed was up to. And that was the setting for Paul Volcker.
Okay. So, George, it's 1951. And forgive me, I'm a big one for trying to truncate my tendency for long monologues. But 1951, an interesting juncture to take off from, because we had just endured profound inflation in the American economy. It was only 2 years prior to that, I believe, that inflation had been running at over 20%. And I also want to say that, of course, we were no more than 20 years since the calamity of the bankruptcy of the financial system in the 1930s. And so I want to say that the Fed's standing was very much low, if you will. It wasn't on a par with remarkably where we find it today. I wonder if you could just, before expounding from 1951, reflect on that inflation. And then secondly, if you could explain the impulse behind that Humphrey-Hawkins why that additional legislation was necessary. So in two parts, but if we could start from the Treasury, I guess, trying to either establish the working relationship with the Fed, and if that had any bearing with the immediate post-war inflation of the late 1940s.
Well, it didn't it didn't worsen it, but after that we went right into Korea. We went into various other programs, the Cold War, the funding required for it, then the Vietnam, and so on. So the Fed didn't add to the fire that was smoldering and was really not dealt with after World War II. I think the interesting thing is that it really wasn't a problem. And the reason for that was the United States is massive, huge. I think people still don't have a concept of how big the United States is. And they had won a war. And there really wasn't any competition to them. And they had the full world for trade. And they were definitely the hegemon. So the inflation at that point really wasn't an inflation in terms of a debasement of the currency. It was a tax. It was John Cochrane's done a lot of good work, but other people preceded him. It was effectively a way to assure bondholders that there would not be a default. Now they're going to get their money back, but in a much less value because of the inflation. But that inflation is a tax that replaces what Congress should be doing, or maybe they can't do. And it's not really a cheapening or a weakening of the U.S. and the U.S. currency. So that really, there wasn't a problem. What was a problem, though, was that the Treasury was at that time giving the Fed orders about like, okay, you got to have the interest rates here, you got to maintain this, you got to maintain that. And the Fed wanted to get back to monetary business as per their reading of that time, the charter. Now, the big problem the Fed had prior to this, I think they had just a huge success in terms of financing World War II. They were a very important, if not the critical factor, for us to make the tanks and Lend-Lease and all that stuff. Was that in the midst of the Great Depression, which World War II sort of nicely for the Fed papered over, and I say that, I guess that's a crass way of saying it, but Eccles sat down with FDR and tried to revive sort of a hard-ass gold standard. We have to tighten, you got to tighten, I got to tighten. And in 1936, that was when the real Great Depression started. The United States was coming out of it. Standard Keynesian ideas were working. They had gotten some insurance for the for deposits. And things were actually starting to turn the corner. But the Fed, in all its brilliance, just went right back to 1920s, jammed the U.S. into a very serious depression. And also, by talking FDR into it, he sort of made FDR betray all his ideals that he was talking about at that time. So they're in a hell of a problem. And World War II actually, and again, this is an incredibly ugly, crass way to put it, but World War II saved the Fed's ass.
But when I hear you say that, heavens, my wicked mind lights up, and I fear, or I'm certainly going to raise a question to explore later on. Are we in danger of doing the same? You know,
I would say we're very close to almost not identical, but history rhymes, and we are right now with the same spend on the fiscal side that I think. In percentage of GDP, it's not too far. It's less than World War II. But in terms of if you're to weight it by how much time was used to get that spend out, it's probably much more drastic and dramatic than what we spent in World War II. World War II, we obviously spent several years to get there. And here we did it in like 6 months and just charged in. The amount of spend that the fiscal side has done in such a short time period, for whatever reasons, we can have all sorts of discussions about that, but it was probably $3 trillion or so beyond what was required to come to either a budget or a solution for the banking system, or to just have people maintain and survive COVID, the lockdowns. And so that $3 trillion went, happily from the average Joe right into their pockets. And then what's more important for some of the very wealthy, it was a massive transfer of wealth to certain people who just had a boondoggle. And so we've gone from like, you can see like the checking and currencies that was on hand was about 2 to 3 trillion, a little elevated going into COVID. But after the CARES Act and other various other measures, it just soared to 5 trillion. And that immediate acceleration of that money is, I think, excess. Indeed. So what we're seeing now,
we're going to show that chart. That's essentially Jamie Dimon's favorite chart. He keeps going on about it, and I think
I don't understand why. Yeah. I hear why Jamie Dimon. Of course, he's certainly got more tool set than I do, but I don't understand why he keeps talking about recession and slowdown in the face of how enormous that money is. It's almost impossible to have a recession or slowdown. We could have a catastrophic crash at some point just because the Fed is like, it's dwarfed. The Fed has no role now. It's just been completely dwarfed by this fiscal panic / surge. I don't know. Again, we could have a longer discussion probably on what caused it. But with that massive amount of money, the inflation is back to like World War II. It's a tax. It's not monetary based. It's not.
Okay. Yeah. Okay. So I think we're kind of split a little bit, and let's see if we can split it open, if you will. So that, and we're presenting these charts. So we're showing that essentially it looks like a 4 trillion distribution of new money, of fiat money, to the household sector.
Classic helicopter drop. Classic helicopter drop.
Yeah. I mean, you say classic, there are very few helicopter drops, but yeah, classic as one would imagine. This is in reality. And then since the pandemic, I think, and we got the chart, household wealth, I think is nominally it's up 25%, counting for the inflation over that period. We're certainly a good 15 to 20% higher in terms of household net wealth. I think I would still caution a little bit that a big chunk of that would be a slow moving valuation mark on property, but nevertheless, wealth is up, and there's been no dent in the money that was distributed to the household sector. And so to your point, why should we anticipate a recession? Yeah. This would seem to argue in favor of rates being elevated and continue to be nudged higher. I guess to Jamie's point, I mean, here we are on this day in the year 2023, the largest, most respected US corporations, from Apple to Google et al., all reported profit warnings. The shock of a profit warning, especially from businesses of that stature, is that they go out of their way to eliminate uncertainty with regard to Wall Street guidance. And they have up until about 3 days before the end of the quarter to ensure that everyone is aligned and on the same page. And so when you get profit warnings, it's pointing to a remarkable event right towards the end of the quarter. And that's why typically the price reaction can be as violent. And so, like you say, there's a lot of, in one sense, monetary ammunition to sustain a very robust US economy. And yet we have the largest of businesses with profit warnings, and more actually, perhaps of even greater import, announcing job cuts. And again, before I end, job cuts are such a serious thing. Companies invest so much money to attract the best labor, and they're so reluctant to give up on the people that they have strived to achieve, that when they say economic uncertainty, they're saying, we don't want to do this, but something is happening in the real economy, which is forcing us. So there's, if you will, these are these two clashing kind of forces that the market's trying to deal with every single day.
Well, comments on that. I think we've never had corporations held by such a few people, and it's a concentrated power base. In other words, there's no longer this massive, our very large distributed shareholders, like we create earnings for shareholders. A lot of the biggest corporations, actually almost all the big corporations, don't have to worry about their shareholders. They can clearly take a 5-year plan. Bezos is still going to get his rockets off. So is Musk. Musk is, if anybody, is showing like complete disregard for any sort of like quarter to quarter idea of earnings management. And I think these guys get together, and I don't think there's many of them. I really do think, I don't think they meet in some like bohemian thing in Northern California anymore, or wherever that was, but they do talk and they do interact. They don't have Epstein anymore, so I don't know what the connection link is anymore. But
yeah, that's not my. Oh my goodness, that's not my language.
No. But I'm telling you,
these are the most observed, scrutinized people on the planet. Elon's
no.
stock is down 2/3.
I was making a joke.
No, indeed, but I still think we do have shareholder capitalism. It's becoming a horrible version. The greatest malaise is the understandable attraction to passive. When the indices have been so hard to beat for active managers, you can understand why the passive is very much to the fore. And passive investing is not judging capitalism, and it's right. Essentially right. A trend.
But what can happen is that Amazon is he can just give up on his shares. He can have those shares go down 2/3 from where they were at the end of 21 and be happy. Like, okay, he's not worth 50 billion, he's only worth 30 billion. But
you can't, I'm not allowing you to say that. I mean, like with regard to his independent wealth, I accept that entirely. But I think there are profound checks and balances and rigors of active managers who will object if there are conscious poor decisions. I mean, Amazon.
Who's the green mailer who's going to take out Amazon because it's mismanaged about their earnings?
Well, why have they actually cut staff? They have admitted that there are many companies which misinterpret.
It hasn't shown up on any employment data. Like there's a lot of noise about it, a lot of discussions about it. But as far as like the weekly initial claims, as far as like just the number we saw this morning, it's not showing up.
Well, that's 100% true. And I think that comes back again to, I think we're on more solid ground with the monetary data. So that monetary data we were introducing with, this 4 trillion of checking accounts, which is still rising. And that's a curious thing because credit card balances are 8% up on the year, and 8% kind of, it's almost as if the poor folk are having to reach to their credit cards to find the monetary elan to deal with the fact that prices are 8% higher in the large versus last year. And yet the cash balances are still soaring. And one interpretation is that, behavior of a lot of economic agents that we call workers, for the first time, you could withdraw your labor. And it would seem that there's still enough money in those checking balances for people to choose a different lifestyle. And that's where the fear is that the unemployment or the employment data seems to be almost the exclusive control function of the Fed. Like, employment strong, we're going to have rates strong. Yeah. And yet if it's being distorted and if behavior has changed, then we might be in paradigms might be shifting. I don't know. I'm curious about it.
Well, right off the Fed, employment, they're yin and yang. That's the essential connection that's in front of everyone's mind, certainly through 22. The Fed has declared that the way they're going to control inflation is they're going to bring the economy down, and it's going to impact labor. They've actually declared that the way to monitor their success or lack of success is to watch how unemployment goes. And the trouble is that unemployment is actually dropping, and employment is either holding its own or actually rising. So it means that either the Fed is just full of it, or the Fed is actually screwing up. They're not doing at all what they said they're going to set out to do. Now, in 2012 or so, there was a really important shift to the Fed's methodology. They went from the Friedman, MV equals PY, to a neo-Wicksell, a guy named Woodford, Princeton. And that's all about, there's a natural rate, a rate that is just endemic to the economy, and it's like written on granite. The trouble is, though, that only the Fed can tell us what the natural rate is. It's very hard to discern. So therefore, they don't have to talk about anything. And then if we have Fed funds over the natural rate, we have some cumulative process going on. And that cumulative process is some secret bank account of some size, by the way. You know, if Fed funds are at 4% and the natural rate is like 2%, then we've got a 2% withdrawal from that cumulative account, and vice versa for the decade that we kept things near zero lower bound. The trouble is, you can't find this cumulative account. You can't see it in the economy. You can't see its effect on employment. You can't see its effect on inflation. I actually think it's bogus. And I think the Fed is staffed with very, very brilliant people. And I think what happened was that they turned full political 2012 with good intentions. They thought that, oh, the whole world's falling apart. Thank God we have the Fed here to save us, just like as, World War II or whatever. And we're not going to make that same mistake that we made in the Great Depression. That's what Bernanke's apology was to Friedman Schwartz. And so we're gonna have to, but we have to stay by law. And this is the series of law that we started talking about. So what do we do? How do we maintain these emergency procedures? The QEs, the extraordinary zero lower bound, and start talking about helicopter money and all these things that went on. Well, what we do is we got to hide the Fed. We have to basically hide the monetary policy from being able to be observed. The guy who preceded me, who I'm just very confident that you would have me after him, Lacey Hunt, pointed out that you can't even get a good M2 read anymore for various reasons. They've gone out of their way to hide it. And there's no other reason why they would. They have all sorts of arcane data points.
The Fed is hiding money.
The Fed is not. It's just hiding that it's not doing anything. My thesis is that the Fed does not have a reaction function now. That they have no way to say that if we do 50 basis points in Fed funds, it will operate. It will end up with even a sort of a qualitative idea of some other variable. There's no relationship now between Fed funds to employment. There's no relationship between Fed funds to inflation. There's no relationship.
You've got a chart, I think. So you believe you believe that historically you've been able to establish a relationship between the Fed's actions and its ability to control key economic metrics like employment. I mean, I think that they're completely guessing. I mean, the complexity of the system is well beyond even the wonderful, smart PhDs that work for this institution. But you have a chart. I think you have a chart, yeah?
I would even go further, is that I would say that I'm very intrigued, or I really like the Fisherian crew on Irving Fisher. And they say, well, and there's some complexity to it, but basically, if people know that Fed funds will be held at a higher level for the foreseeable future, for the long term, then the economy actually expands, not the other way around. And if Fed funds are to be dropped, the economy actually contracts. That there is an obvious relationship between risk-free rate, it's called the Fisher effect, and the economy.
But isn't that another way of saying that when interest rates are very low, it's actually because the economy is really stuck, that you would never desire to have very low interest rates as indicative of profound problems within the economy, and vice versa. Actually, the opposite, the inverse, the logical riposte to that is that high interest rates are actually a reflection of an economy which is performing.
Not if the higher interest rate, the interest rate structure is maintained at a certain level for not in terms of a shock, but in terms of like a year, 2 years, and people can look forward to that. There's obviously a high correlation between the interest rate level and the GDP growth. And that's just, you can't deny it. You just look at any chart. You can look at it in a very sort of naive way, or you can look at it with and it can get pretty complex. It's there.
Well, let's keep it simple. Okay, so if we look at a price of the ultra long bond, the US Treasury ultra long bond, and we use the ETF, is it TLT or which one? And you look at that, and you look point to point from 2004, let's say, to the present, the price is flat. Now, there's one argument that says the price should be flat. That's indicative of interest rates being constant, and over a 20-year period, they should be constant. Would you agree that using a starting point of 2004 to the present day, that the long-term rate of risk-free rate for US Treasuries should have been flat? I mean, how would you perceive it to be? I mean, I'm stating the fact. What's your perception of what it should be? Is that correct?
Well, this feeds back to like the likes of Larry Summers going into secular stagnation and such. And there is obviously a relationship between economic growth in the US and risk-free rates. It just can't be denied. Usually people talk about the 10-year, that the 10-year has some proximity to GDP growth for 10 years. What that is, there's all sorts of noise. There's all sorts of complexity to that, but that you can't deny it. That is what happens. And I think 2004 to date is perhaps not a meaningful period. You should go like to mid 70s to today.
Well, I want to push back on that because I don't really like bringing up Larry Summers, but to the secular deflation point is
I'm not a student of them. Don't worry.
I imagine so. But since the great financial crisis of 2008-9, it is just a factual observation that the trend growth rate in Western economies has lost about 1 to 1.5 percentage points of GDP growth. And if you imagine,
where have interest rates been?
Well, we'll come to that. But to that point, interest rate, if we now take the reset in today's treasury price, prices are flat, which is to say rates are unchanged from 2004 to the present. And why I'm pushing back, you're saying let's go back further. I'm saying that actually there was a consistent observable trend of US GDP growth. And for the US GDP, you could say Western GDP was compounding at close to 3, let's call it 2.7. And since then, almost for 15 years, it's been more like 1.5%. That's the deflation. And again, you were remarking about just the enigma of the US, the size of the US, that the US is $21 trillion, that the global GDP is $100 trillion. And so to have lost, let's say, 1 percentage point of growth, you're losing $1 trillion a year. And over 15 years, actually, the lost output begins to rival that of the size of the entire Chinese economy. So again, that's why I'm saying let's focus on that, because if I have a beef or a curiosity today, it's that the market has reset and said, actually, despite having lost $15 trillion of lost output, we're now saying that rates should have been flat over that period. Whereas I believe, I guess, to Larry's point, still in a secular deflation, which has not been addressed, and therefore rates should be lower than they were in 2004. That's kind of where I'm seeking to explore and expand from your mind and the dialogue that you pursue.
Well, we just back up just a little bit. Like my whole economic knowledge and my knowledge of monetary economics and the Fed is not bookish. I had a pretty well a beer-soaked history BA degree that I barely got through. But I like to read a lot of shit on history, so that's what got me through, because it was just an avocation as well as trying to be a student. My whole knowledge comes from being terrified that there's no way I could possibly survive in a seat from 1981 on, when I'm sitting next to a Harvard MBA guy, this guy, that guy, the war, all these characters that were into the pot then. And so it was totally related to, like, how do I sell a long bond to like a rather sophisticated client, or later, after a couple of years, how do I survive my P&L? I don't really care about theories and economics and MV and P equals PY, although those type of concepts became the easiest way to understand what was going on so that I could put the right trade on.
Yeah, an abstraction. But in terms of making money today, in terms of risking precious capital today, we have to kind of determine what's the right interest rate.
The right interest rate is that stays in a certain proximity to the US GDP growth or decline. Now, it's pretty easy to say that probably the US is going to be hanging around for a couple more decades, if not a couple more centuries. So therefore, the growth will be positive. We know that. We're not going to have a sustained Great Depression or stagnation. Larry is out to lunch. We are going to have a growth commensurate to just the power base of this country, which is immense.
I don't know about that. I mean, again, I'm not. No,
I hear you.
I'm not defending Larry, but we've lost. Something mercurial happened and significant happened around that period, 2008, and since the system that we grew up with, the system that we admired, the system that made us rich, feels broken. It has failed. It's missing 50. It's missing the Chinese economy.
I think I agree with you. Why we're allowing mercantilism sourced from China when they only have one aircraft carrier, or they didn't even have an aircraft carrier then, but we still we trade it with China as if they're like Perry sailing into the Tokyo harbor, and we're shock and awe and say, okay, we'll trade with you. I'm baffled. Why
It makes rich folk even richer. The oddity of today is the alignment between the billionaires and the Chinese Communist Party. They're actually all together.
I worked with I don't, you sort of started to look askance at me when I started talking about like what Bezos is doing and stuff. Be it far from me to understand him. But I was with a firm called Morgan Stanley. We're at a conference in Shanghai, and we're in this like incredible hotel. I mean, it was just like just amazing. And we're all sitting there talking about business, not to do with Shanghai. So you're sort of wondering like what the hell we're there for. But we're all like really enjoying it. We're enjoying the Chinese are wandering around, and we're there. And as we look on this sort of penthouse place, the Morgan Stanley guy, who was a pretty tough Queens real estate fella, and somehow he shows up in Shanghai, but he did a lot of business. And he proudly says, look out here, look at all these, half of these skyscrapers that you see, those are Morgan Stanley projects. So there's good reasons why we allow this mercantilism and the thing to duck. You're absolutely right. It was about a few agents who just made money hand over fist. And as far as like the poor guy in Sandusky making plastics or toilet bowls, well, he's shit out of luck. It's the most irresponsible serving of the public that I think the U.S. has ever done, and it went on for decades. It's still going on. It looks like we're going to have wave 3 or 4 coming on again. Now, that I think explains a lot of the Great Deflation. I think that explains a lot of like this idea that core GDP, our nominal GDP, is lower now. It's now 1.5 versus 2.5, 3. We are just selling out the country, and it might be the right thing to do. Anyway, I didn't really care too much about it. I just wanted to make sure I was on the right side of the long bond. But that is what's going on now. As we come into where we are now after the Great Recession of 08, 09, that was clear. That to me, that was not an indigenous event. That did not happen from U.S. banking or finance or greedy bankers running around. My point of view, and I really was at ground zero at one of the biggest holders of mortgage derivatives and securities, and it destroyed our business. It's why I have time to talk to you, because it really hurt. And I was in U.S. Treasuries, so I'm blameless, and I said the right thing in the meetings, but it still was a horror show. And these guys went over and they're bright guys. I mean, we're talking about 20 PhDs at a go. Away they go. This and that, vectors, prepayment flows, the optionality, everything. Far, far brighter than anything depicted in The Great Short or with Lewis's stuff or anything. And they really knew it, and they really did good trades. But
I fear those smart guys got to you, George. Like I made a career.
No, I have a rule that if you put more than 3 PhDs in a room, their IQ collectively drops about 40%. So I'm with you on that. And their ability to stay willfully blind, especially if a career enters into the picture, and they all we either stay together or we all go together.
Yeah. Over here we call it the arrogance and the conceit of a well-formed argument. That's their Achilles heel. A well-formed argument.
It was an amazing nightmare that didn't happen in a flash. It was day after day, week after week, month after month, of steady progression into the abyss.
Okay, so staring into the abyss, right?
Yeah. Now, where that came from was Bernanke was right. He's not a dummy, that's for sure. It was excess savings. Remember that tag word? Those weren't U.S. savings. That was the Chinese surplus from the trade, where they couldn't convert their dollars into yuan, because if they did that, they would destroy their currency and it would destroy their whole ability to export to the U.S.
No. Hold on. Hold on.
That's the basic tenets of mercantilism, though.
No, but it's not. It's not, George. So it was surplus savings, agreed. The origination was China, agreed. Okay. And again, it comes back to this yin and yang of the US billionaires and the Chinese Communist Party. Chinese Communist Party's principal objective is tenure. It wishes to persist in perpetuity. Therefore, it needs to enrich its citizens, but a little bit like a frog, it can't have you kind of it has to induce you slowly, where you're not aware of the machinations which are going on. So the problem that they had was the surplus from the trade, which was substantial. In classic trade economics, should have reflected itself in a higher exchange rate. The capital account would be open. Their comparative advantage from that infrastructure, from the power of transferring the peasants to the metropolis, would be able to afford a higher value for the Chinese currency, that the renminbi could buy more dollars. But in doing so, you would be enriching your citizens. And heavens forbid, can you imagine rich citizens? They might get too enthusiastic, and they might buy lots of things, and they might create an economic cycle beyond the powers of the CCP to control. And God forbid they had a boom, because we know that the symmetry in life of booms is that they're followed by busts. And with a bust, the CCP party might be evicted. And so the surplus of savings was very much a conscious decision on the part of the Chinese Communist Party not to enrich their citizens, if you will, to keep that frog gently falling asleep. That is the essence of the problems confronting the global economy today. That, surplus savings, another way of saying it, is a deficit of demand. I'm talking to you about 15 years. There's been a $15 trillion deficit of demand, and I lay it firmly at the footsteps of the Chinese Communist Party.
We can sign off on that together. I completely agree. I think you might be looking at the liability side. I might be looking at the asset side, and that's just an excuse, probably.
Yeah. But, so back to Bernanke. So in order to, they've got a closed capital account, and to control the price, they had to take those dollars and buy dollar assets. To my mind, the great unforgivable mistake of US policymakers was in the noughties, that there was this enormous demand, a huge demand. I want to say $5 trillion of demand to buy safe US risk assets. And it was an opportunity for the US government to run big deficits and to match the infrastructure, the great infrastructure expansion of our Chinese counterparts. And they didn't. I think treasury paper in that period from 2000 up until the crash of 2008 was like 1.5 trillion. And so the folk that the smart PhD folk that you were despairing with, the smartness was, well, if the government ain't going to create the safe paper, we'll do it. And that, of course, was the mortgage-backed securities, because they were deemed to be bringing safe mortgages, bringing it into a portfolio, adding an overlay of geographical diversity. You could actually sell it at a higher price or a lower yield than US government securities. And you would therefore square the circle. People want to buy safe, foreigners want to buy safe assets, and you sell it. And that's what they did. They sold it to the overseas sector.
Absolutely. It went to Germany, it went to the Dutch, all over the place. And the problem with the mortgages wasn't the subprime or the really hairy stuff. People were pretty aware of that. And I don't think many people got that hurt on it. What really destroyed people was the AAA senior tranches. And they're after LIBOR plus 12 basis points or LIBOR plus 25 basis points. And when it glitched down to 99 bid, they rather than like go berserk, like, oh, it's broken the buck, like any mutual fund would have done, and say, this isn't cash, it's not a cash substitute. They say, well, I'll come back. And then it went to 98, then 97, and then so on.
Yeah,
so
again, the conceit that they had, it's a bit like Warren Buffett's argument that, it's never been wrong to be long US equities. And you've got over 100 years of data that substantiates that point. And I certainly wouldn't contest that because it's factual. And that was the case with the US mortgage market. We had no observation point of a nationwide house price decline. So the argument was well founded, but the conceit was it just takes one observation to disprove the thesis and to disprove the riskless nature, and therefore the pricing consequences are horrid. So George, I kind of want to interview you. I'm getting fed up with Jay and the rest of them, and I'm looking to hire and appoint a new Federal Reserve chairman. And I'm thinking you maybe you're my guy. I want to interview you. So I've got, maybe let me conceive of a series of questions. So
I'm sorry, no interest, but carry on.
Play with me, George. Play with me. So I wish you to comment on your predecessors' decisions since this tumult of 2008. Yeah, and what I want to say is that in 2013, our friend Bernanke kind of went, oh my heavens, the economy seems to be getting quite spunky. It's getting quite strong. And I think we may have to look to rein in our monetary expansion. And of course, 2013 was the taper tantrum. And so effectively, and perhaps wisely, he subjugated it to the private sector, said, what do you think? And the private sector went, oh my God, these clowns are worried about the economy being strong. If they're worried about the economy overheating, we better worry. And we doubled the 10-year from 1.5 to 3 when adult unemployment was 7.5%, and it wasn't obvious the economy was overheating. And we doubled long-term rates, and guess what? The economy just kind of withered again on the vein. So that kind of, the talk about raising rates went by the way. And then we had dear old, I've got a soft spot for Janet. She's just like, she's like your grandmother, and she made some sound non-bombastic comments about the labor market. She expressed concerns about her understanding, but she wanted to kind of nudge rates up, and then kind of thought better of it. Nothing really happened, except again, all that talk kind of kept the economy, from really expanding, from being unmoored. And then finally we had Jay. And Jay was just determined that he was the phoenix of Volcker rising again. And he went for it in 2018, didn't get confirmation from our brethren in the risk markets. We slapped him with a 20% drawdown in the S&P. He went back to the recesses, and now he's back again. So am I being unkind? Is Zed dead, George?
Oh, definitely. Yeah, it's a chopper, baby, right? It's not a motorcycle.
What motorcycle is this?
It's a chopper, baby.
Whose chopper is this?
Zed's.
Who's Zed?
Zed's dead, baby.
Zed's dead.
So did they get it right? What were they doing? What would you have done differently? Tell me.
Well, I think it's a shitty job. And the reason is that you're just doomed to failure unless you lose your integrity. The Fed, as it is now, cannot operate given the law set that it has to work with. It has to lie. It has to fabricate. It has to be very political, and it has to abandon monetary policy in terms of way people understand it, for the most part. It has to go into expectations. It has to go into the dissonant Fed. It has to go into wordsmithing. It can't be a monetary institution with that ass now. So therefore, I don't want the job.
Why can't it? Remind me why it can't do that.
Because it has no relationship to the economy given the current tool set, especially with this Woodford neo-Wicksell. It's a lie. There is no natural rate. There is no cumulative account. And they've never cleared that up. They've gotten deeper and deeper and deeper into this lie. And by doing so, they have to look backwards and say, well, actually, we did a good thing because we did this, or we did that, or we're worried about climate change now, or whatever. Our Yellen saying, I'm worried about my dad as a working man in Brooklyn. All qualitative, all subjective, all bullshit.
Okay, so we clear them out, and I bring you and your team in. What are you going to do? You got a clean slate. What are you going to
do? This is where it's a big problem. I think of Huey. What's his name? I need a new drug. We need a whole new set of law and procedures. We need to rewrite the Fed Treasury Court of 1951, and we have to have a monetary bank that operates as a monetary bank. They have to be away from all this policy. A big move right off the bat is to get rid of this dual mandate crap. It's a fallacy.
What is a monetary bank? What is a monetary bank?
A monetary bank controls the bank system. It regulates the banks, and it's a trim tab. It is not the economy. You can't control the economy. In an emergency, it can take advantage of MMT, which is what World War II proved. MMT is not bullshit. It's obvious. When the country needs money, the Fed can print money. It can finance anything. There's no problem with it. They could have done 3 times more than what they did for COVID. They could have. If the war went on for World War II, they could have done double that. It's not a problem.
I have a pushback. You will not be surprised. I have a pushback on that. The government, as you say, can do anything. Like a hegemon can kind of do anything. But for it to be sustained, it requires a change of it requires that action changes and convinces the behavior of private agents. The private agents see what the government's doing and say, we're being underwritten, that we misjudged the level of risk. We evaluated it too highly. And with our friends in Washington and elsewhere, actually, we can bring it down. And you know what? Owing to that, we can actually expand our risk-taking capacity. And MMT, etc. I think the fallacy of those models is they've never convinced the private sector. Japan is a great example. The government has expanded fiscally to debt levels beyond anyone's imagination, and the private sector has not been convinced to lower its risk aversion and seek expansion. That's my complaint with that.
I would look at it from a different angle, I guess. Not to debate what you said, but the idea of MMT is first, it's not new. It's like the idea this is a brave new idea and concept, and it's actually a perversion of chartalism, which was the basis for Keynes's understanding of monetarism. So it's just chartalism, i.e., the king owns the salt, and the king's salt is something that if you take, the king can compel you to pay taxes. If you don't pay taxes, you go to jail, or he might shoot you. So the king can compel any amount of money they want from you from tax, and therefore its dollar bill, which is used to pay the tax, is of whatever value, whatever size the king wants. Now, we have checks and balances. We have all sorts of different people arguing, so that's good. There's not one dictator saying, well, I'm just going to go issue $10 billion or $10 trillion. However, World War II did do that. And the COVID panic, our sort of mendacious political move, whatever you want to call it, also did it as well. So that was proof that the United States, if it operates in sync, if it operates on full voltage, has the ability to raise pretty well unlimited amount of money. Now, after they do the money and they go buy some guns or they go and send an unemployment check to everybody every week, there's the residual, what follows. Now, if the government goes out of its way to convince people that, look, we know we did an extraordinary amount of financing here. We know our fiscal spend was unusual. And we know it's outside of what your expectations are for the next 30 years or 50 years or whatever duration you need to reach a reasonable idea of risk. So therefore, we are going to cut this down, or we're going to increase these taxes, or we're going to do some sort of reasonable management or even concern, maybe just point that out. Is if I'm any use to people at all right now, based on all my experience, is that the Fed is grossly overvalued at this point, that it is not an issue, that is not really conducting monetary policy, certainly nothing that will impact inflation. And what's going to come through is the nominal GDP, which, based upon how much COVID spend has gone into, is perhaps going to get out of control, but it is going to carry on for at least to the next election. Now, as we get into 2024, people will start to make it an election issue. There'll start to be a debate. Inflation's still somewhat sticky, but
hold on, it is an issue. The Republicans by a slender margin do control.
Yeah,
and therefore their number one objective is a change of president, and therefore there will be no additional stimulus. In the unlikely event that the economy, unlikely to many, that the economy suffers a reversal, they will very much be resisting all attempts to do more priming. So they're already in that environment. So really, right, for additional, and the money is being distributed. The effect of the money just now is being felt, I think, as we discussed earlier, on this participation that Labour still seems to have been withdrawn voluntarily and cannot be enticed back. Mm-hmm. But for for nominal GDP and further additional incremental growth from this point, it requires the private sector. It requires a monetary phenomenon.
I think I would suggest that you're underestimating how huge that stimulus was. It was something we haven't seen since World War II.
Sure, no, I'm not. But it's five. Let's call it five. Let's call it $4 trillion. A big number. Choose a big number. Okay.
It's going to be.
But the question is, but incremental growth requires an increment. It doesn't require going back and measuring what has already come to pass. What has come to pass is there in the behavior of the labor pool, but it really doesn't have that great a bearing in terms of incremental growth. Well, it sustains you where you are, but doesn't propel you forward.
Well, the excess was, say, 10% of GDP, of current dollars GDP, and you could say that, well, we've had 10% nominal GDP growth, so therefore it's over with. But we still have the underlying growth, the fact everyone's got a job, people are spending money, so even a routine growth, whatever that is more than enough to keep things carrying on, especially with the good memories of 2022. The average Joe still has his pickup truck. They're probably now thinking about getting into a bass boat. Do
you think so?
Things are good.
I don't think so. I really don't think so.
I just
22 was the mirror image of 21, which was grotesque. If you go into Europe, GDP nominally is marginally higher than it was pre-pandemic. In some economies like the UK, it's below.
Well, I think that would be the case if all they spent was, they say, 2 to 3 trillion. That would have been a budget, fix. It would have repaired, and they would have gone back to where you are right now, like equal, I don't think we've seen the real growth, or not the real growth. That's the wrong word because I shouldn't use the word real. The growth is still to come.
Where, how it needs sustenance. So again, if we're talking $4 or $5 trillion, if we're talking about US GDP being, like, call it $21 trillion, we know that prices rose 10%. So we know that maintaining your expenditure of last year's basket of goods and services will cost you $2.1 trillion more if you're going to sustain the same level of consumption. And that's kind of like, it would seem to be half of those cash checking deposits that Jamie keeps referring to.
All the statistics I look at, and retail sales, housing, construction, manufacturers, delivery, inventory, back orders, they don't indicate any slowing. They don't indicate any plateau.
Why are we disengaging the inventories? There's clear evidence that there was an overstocking by the corporate sector. And all of the manufacturing surveys are in deep recessionary mode.
I got some data to back that up. It's not. I don't think that's valid. Do you? I think that
give me one example of data.
The inventories are kept on a nominal basis. So right off the bat, as you point out, 10% of that expansion is just inflation. And that's it's current dollars. And then sales has grown way more than 10%. So the spread between the inventory to sales ratio has actually shrunk. It hasn't expanded, it hasn't been maintained. It's actually showing that there's perhaps going to be choke points coming up. There's going to be problems with supply.
We have phantom container ships that are returning empty, that are not going into Chinese ports because there's nothing to take back. That level of, is it called phantom? There's a term for it, like phantom. It's never been higher. There's been a big, Amazon invested in like almost $1 trillion of like new inventory, what do you call it, depots for storing, for parceling, and for storing the stock that they commanded. And then, like, they can't fill it. They're like, oh my God, we messed up.
Well, again, it's just what you're saying is certainly the common understanding.
I'm a common man.
Well, I don't want to. I'm not dissing you, but the data doesn't back it. I'm sorry.
GDP is decelerating, and it's being boosted by the fact
it's going from 7% to 4%, but it's still strong. It's very strong.
Sure, but the constituent parts, the growth that we saw, especially in the final quarter, came from the fact that imports are a drag. Like if imports are booming, then that's a drag on your GDP and how you calculate GDP. If imports, the rate of growth is decelerating, that actually boosts your domestic GDP, if you will. A lot of growth is coming from China, and the malaise of China is a reflection that the inventory cycle is on its ass.
Well, this might be where I don't want to sort of bullshit and say I'm just a dumb guy from the country, but this might be where I'm just a sort of an old drunk historian student that barely got through. I just look at what the data is. I unlike the Fed and everyone else, I am data dependent. It served me well, and there's been a huge disconnect with the perception I expressed in stock markets versus the reality of what the economy is doing. And the U.S. economy is a pretty big beast. It doesn't turn on a dime. It doesn't like just suddenly drop. First, it will never drop. It might plateau out. It might slow down a bit. Larry might be right, but it's not going to drop. And just if it plateaus or even maintains like a 2% growth, we are still grossly undervaluing assets in comparison to this level of GDP that's going to be with us for a while at least.
Well, grossly undervaluing the value of assets versus GDP. So, that doesn't talk to the very elevated valuation of stock market and other real assets.
I think these evaluations
are to GDP. These are unprecedented high levels.
the valuations that's going on right now are I don't understand them. I don't understand the earnings.
Sorry, but you've told me that financial assets seem to be remarkably undervalued to the level of GDP, and I've countered with the fact that statistically, financial assets have almost never been higher when calibrated by GDP.
Well, I can show you the stuff I've done, and I see it otherwise.
But you would contest that stock market capitalization to GDP is pretty much at its highs.
No, I would say that that as far as like if you just look at prices, like what the potential return that you might look at from owning an asset in comparison to GDP is probably a historical cheapness.
What? Okay, so tell me what that means, because I'm kind of long in the tooth about as a market participant.
It's a real rustic idea. I
like rustic ideas.
I just take the broad indice, the Wilshire 5000.
Yeah.
And I just regress it to current dollars GDP. A big problem people have, which Atlanta Fed is starting to, which has corrected a lot with the popularity of the GDP now. But the trouble is the Atlanta Fed's GDP now is real, supposedly. It's like, it's not nominal. So if you take the Atlanta Fed GDP now, add like the Cleveland Fed's live casting of inflation, you have a good proximity of the nowcast GDP current dollars.
But can I just ensure that my understanding is correct? Because I think I'm still not getting it, because I'm pretty sure, and we'll post this chart. I'm pretty sure if you take the 30-year nominal GDP growth rate in the US and you rebase it to 100, and you take the Wilshire 500, is it 500, 5,000?
5,000.
5,000. You take that broad stock index and you rebase it to 100. I would imagine that the endpoint, the Wilshire, is, let's say, at 1,000, and nominal GDP is on that basis. I mean, let's take away from. I want to say that there is a huge positive deviation where the Wilshire is trading versus the trend growth rate in nominal GDP, and it's very high and very high historically looking back.
That's certainly the common understanding, and I'm not dissing you, but being sort of a little more naive and just a sort of a show me type guy, I did exactly what you're saying. And then I also went out of my way to figure out like what Fed regime we're in, like what segment do we use of correlation between the Wilshire 500's indice versus GDP current dollars level. Are we in 1980s? Or are we in like 90s, 2000s, the aughts? Where are we? Well, I figure that a good idea is to actually, I don't think. I take some machinery. I'm a slave for this programming R, not because I understand what the hell I'm using, but there's all these beautiful libraries, and there's one library that I use which picks out the segment between two things you're trying to figure out the relationship for, in terms of what's the best time to use to come to an opinion on how they're trading, how they are versus each other. And after doing that, I find the best explanatory segment is from roughly about either 2008 to 2012 to about 2021, 2023. Don't argue with that. That's the 0.94 correlation. Correlation is not causation, but anyway, it is pretty high. So I run that, and I find pretty well the opposite of what you're saying, is that the Wilshire 5000 is it's about 30% cheap to the relationship it used to have to the GDP current dollar level. That's
quite a statement. That is quite. I mean, that's quite a statement. It's noted, and I wonder if you would share with me that'd be wonderful.
Sure, I'd love to share. Yeah, I'll send you all my stuff. The thing I'm saying is, if you think about it, you can just use common sense, is that GDP current dollars did not drop 20% from 2021 to 2022. It just didn't. Okay. Correct. Not only that, the GDP current dollars, it did have a bit of a hit, to say the least, during COVID, but it snapped back right away because of this money we talked about, the stimulus that was thrown at it. And then times two. So that was not the issue. So you had the one side of the Grand Canyon, the other side of the Grand Canyon. It all came in a very short period. By 2021, that was over. So at the end of 2021, we have GDP current dollars at about the same level that we went into it at 2019 with some growth. We're the same. Now we go into 2022 and we take off like a Musk rocket. It just takes off.
What takes off?
Current dollars, GDP, nominal GDP. It took off. It went from not 21, 22. It's not 21, 22. It's like we're now 26 trillion. It improved.
No, it's not 20%. It's not 20% higher.
It is a big problem people have with GDP is that they're always lagged. They're always looking at it was 3 months ago.
Sure, but since the end of 21, GDP has not gone from $21 trillion to $25, $26 trillion.
No, I didn't say that. I didn't say it didn't start at 21. So, but I can like rustle through. But what I'm saying is that you had the Fed did it. Current dollars, they had a 7.5% increase of GDP current dollars from December 2021 to December 2022.
Okay,
that's what they reported. That's a lot of growth, and that was not repair. That was new growth. Now maybe it's shabby inflation back. Maybe it's just nominal. It's not real. All these things that most people try to say. But the main fact that the main characteristic that people keep coming back is that the Fed is magically going to take that punch bowl away. That they're going to decrease that growth such that the inflation will disappear. And they're saying that means that they're saying the Fed is going to drop current dollars GDP now by about 3 trillion. That's the only way that Fed can have any effect. That's not going to happen. The stock market, though, since the beginning of 2022, has traded as if that already happened. They've already discounted, and they came back a little bit after I see JP Morgan's earnings.
I mean, with the exception of a few, with the exception of a few wonderfully overvalued tech stocks, the S&P is maybe no more than 12% below its all-time.
Well, I got to have an argument for that, right? Otherwise, I'm just full of it. And my argument is that there's two types of stocks. There's what I call short duration stocks and long duration stocks. And by the way, if you heard that, I think that came from me, but I've been using it for a while.
Yeah, well done.
Short duration stock is like the companies that prosper immediately. If the economy improves a little bit in a couple of weeks, it goes right to the bottom line.
Cyclical
right.
stocks.
Long duration stocks are all the tech companies. They're all based upon growth, a ramp. And so therefore, what happens 5 years from now is of great importance to valuation for Google. It always has been. Microsoft's calming down a little bit, but
not contesting that. Yeah.
Okay. And then on top of that, I do think they're doing intense earnings management. They are managing for a recession. And I know these are great guys. I know there are all sorts of checks and balances and people watching over their shoulder. But I do think that rather than take a dollar earnings today, they are purposely working with it so that it's going to come up a year from now. They're going to be on the other side of the valley. And then they really want those earnings for whatever reasons. That combined the fact that the tech stocks are not the leading sector anymore. They are not the area that will, they're a big part of the S&P 500, but the Dow Jones Investment Average, industrial average, but for the fact that Apple's sitting in it, is a completely different vehicle since about October, September than the S&P 500. The Russell 2000, forget it. They're not even thinking about what you're talking about. They've been off to the races for a while now.
The Russell 2000 has been off to the races for a while now.
Pardon?
You said the Russell 2000 has been off to the races for a while now.
It's since about September, October. It's done very well. Check it out.
I mean, it's below where it was a year ago.
Yes, but it's almost like it's not fully recovered, but it's gone a long way to recovering. There's a huge popular perception that we're in the dumps and it's going to get worse. You don't even know how much pain is going to happen. It's going to be bad, bad, bad. But it does not sync with the reality of GDP current dollars.
I just don't believe that the equity market. I don't believe the equity market is saying that the world is going to get really, really bad.
Well, it's S&P 4100. If it had tracked with the GDP current dollars expansion for 2022, it'd be trading around 5,000 now. And that's just the.
If I was tracking whatever I'd be.
No, what I'm saying is that's the relationship it had from 2012 to 2021.
The relationships are jumpy. Right. So I'm very conscious. Time. So, so you're bullish. I don't like these terms, binary terms of bullish, bearish. You can make a very constructive case that risk assets are to be purchased here. Yeah.
Well, I would actually. The short hairs are up, standing up. I'm describing a world that existed like before 1913, before we had a Fed. We're talking about phenomenal manias and then phenomenal crashes. We need a Federal Reserve Bank. We have to have one. Otherwise, capitalism can't function.
Again, what does a Federal Reserve Bank do?
The Federal Reserve Bank is the trim tabs. Like what's keeping the plane up is Bernoulli's principle and the big wing. That's fiscal policy.
Josh, what if the world changed? What if the principal problem? What if the principal problem is change occurred out with the spectrum of the Federal Reserve's purview?
We completely agree.
Yeah. And okay. But where I'm going, the solution of having a monetary bank would be neither here nor there. Where I'm going is that we've generated more, I want to call it non-sovereign US dollar creation than sovereign creation of dollars, that the dollars created within the domestic US banking sector is now very much in the minority versus the dollars which are created outside the sovereignty of the United States. And obviously I'm referring to the euro dollar system. And that the problems, we struggle to be able to go back and name a period in recent history, going back 30 years, where we can celebrate the Fed for being correct. And over that 30-year period, the common denominator is that what am I calling it? The non-sovereign, it's certainly non-sovereign, the dollar creation taking place outside of America. So it doesn't require US loans to create that dollar. It requires an overnight posting of collateral, and you will receive new dollars. That such as its size, such as its impact on the global economy, that to be ignored is leading the Fed into darkness and a consistent series of policy errors.
I would. First of all, I see the Federal Reserve as the most noblest, greatest invention of the U.S. democracy in history, in our brief history.
I'm not against it per se.
No. It's so required. I also disagree with your idea that there's this offshore dollar thing beyond our domain.
Yeah.
Just ask Russia about our reach and power right now.
Those states are not mutually consistent.
It's very important. It's a very important concept. There is no such thing as offshore dollars.
I disagree.
There's only American dollars.
No, I disagree.
They are.
That's factually not correct, George. That's not correct.
Well, okay. I'm an Iranian, and I try to put a whole bunch of money in London, which was the start of the euro.
So first of all, to have any relevance, okay, we can't use examples from sovereign states which, owing to misdemeanors, are excluded from the global banking system. So Russia's excluded and Iran is excluded, and they feel that exclusion.
Okay, well, let's use a Belgian dentist.
Okay,
he can't escape the U.S. oversight. It's impossible.
I'm saying to you that in the 1970s, I am an Arab nation, and I suddenly have an enormous trade surplus. I'm receiving more dollars than I can spend, and I put them on deposit
with Citigroup or indeed Societe Generale or whatever you name to mention, I put a dollar deposit out in a bank outside America, and that bank goes on to make a loan in dollars. That bank has created United States dollars outside the sovereignty of the Federal Reserve and the American borders.
Where'd you get those dollars?
I mean, just like dollars are like they don't exist. I mean, where do you get dollars from a counterparty, right? And so the Fed model is I'm a household or I'm a corporation, and I go to my bank and say, you know what, I want to expand my risk taking. I want a mortgage. I want a loan. Give me credit, and you pass muster with the credit officer, and they give you that. And you've created dollars. What are they? They are a digital ledger. Okay, it's the same thing. I am Societe Generale, and I lend $100 billion to the Brazilian government in 1974. Like, where did it come from? It's just a digital exchange.
Hugh, I can see if the U.S. doesn't care about those dollars, then you're right. It's effectively outside the domain of the U.S. But if the U.S. cares about those dollars because they're screwing with the Fed monetary policy, such as it is, or their taxation, it's the Irish double Dutch scheme, all these things, then it becomes very quickly, and maybe it always was, under the power of the United States.
Well, okay, let me push back again. So the 1970s, the inflation of the 1970s was the Federal Reserve was raising interest rates to try and discourage bank lending to the private sector, because inflation is a monetary phenomenon. So they wanted to rein in monetary creation. Okay. However, by that point, the majority of monetary creation was coming from dollar creation in the offshore market. And it was very risk seeking because it wasn't regulated by the Federal Reserve. You didn't actually have to have reserves. It wasn't reserve limited. This was, you could lend as much as your counterparty had faith in your credibility. It was very, very profitable until it wasn't.
Well, Walter Wriston found that was a problem.
It becomes a problem, yeah. And we had.
In other words, it's not tenable. You can't. The size of money that you're talking about cannot operate outside of U.S. sovereignty. Now, a few guys like drug dealers and suitcases of Ben Franklin's can, but I don't think.
But it creates periodically the most monumental global reset. So we had the profound and deep GDP contraction of the early 1980s. And we had essentially the bankruptcy of major U.S. lending institutions bankrupt owing to sovereign lending.
I don't disagree. I have a different view. I have this view. I agree with you. But the point I'm trying to get at is that, okay, this is my thesis. My thesis is the current caution that people have in owning risky assets in the U.S., especially U.S. equity, is almost completely based upon how they perceive the Federal Reserve's capability. Nothing else. That's what's going on. There's no mortgage crisis. There's no housing crisis. It is solely based upon the fact that Jay Powell has said he's going to hurt you.
I would go further. That is a view, and that is a view of many participants. My critique of many major institutions is they spend all of their time guessing and pondering on the Fed's next act. My point is, I am completely the Fed is, it's not irrelevant, but there are wider forces to bear. That money has been humbled. That this non-territorial dollar creation, the dollar creation outside of America, I believe that has inflated risk assets since 2009, not Federal Reserve tokens. I'm saying to you that when I look at collateral-based dollar creation, it is in retreat. It is in significant retreat. And that's when I become fearful about the course of nominal GDP over the next several years.
Okay, I understand you. And
many people don't. It's the
Well,
accent.
no, I think I do. But just get to like how do you make a buck in this market? We'll put it this way: is inflation here? Yes, I don't think anyone would
No.
argue with it.
No.
Is it going to be around? Is it going to be around for a bit longer? Probably.
No.
You think it's all going to inflation's not here?
I mean, let's do just do the damn tenets of economics. Inflation is what? It's a monetary phenomenon. Okay, show me the monetary phenomenon which is growing at 8 to 10%. It's not. Like the euro-dollar system is actually retreating, and the Fed's tightening. I'm not seeing loan growth of a substantive nature that could support double-digit or high single-digit rates of inflation. It's a monetary phenomenon, George.
It only in terms with the Fed's operating as a trim tab.
Forget the Fed. Listen, you have look. This is my phone, but really it's my wallet, right? And I get paid an income. I provide a service. And I do. I paid for my podcasting, but I do a service, and 100 comes in. And I spend it all last year, right? Okay, I'm in equilibrium, okay? The following year, everything that I want to consume from last year is 10% more. If I don't have 110 going in, then 110 can't come out.
Right now you're getting.
So I've got to cut back. I've got to take 10 out of my budget. That's called discretionary spending. I mean, look at oil this year to date now. Oil's flat. It's on its ass.
But the data has it that wages are keeping track with inflation, even exceeding inflation because of the growth that's going on in the economy. The times are happy now.
Wages at the aggregate are not rising, accelerating at the historic rate that we saw in the CPI last year.
I'm afraid they did.
You're saying wages for the entirety of the US, wages rose 10% last year.
Almost like percent point per percent point is inflation. People didn't suffer.
I don't see that data.
Well, don't take my word for it. Go to the Atlanta Fed. They have a beautiful thing, the wage tracker, they call it. It's a really neat, nifty tool, and there's
a lot of poor folks saying, what am I doing wrong? I didn't get a 10% wage increase last year.
Well, you're an entrepreneur. You're long duration, but you're not like a normal guy.
I hang out with the
belly of the beast. The belly of the beast has done quite well. They have. It's just
they have.
I can't. I'd be the first one to back up that up, but I can't find any numbers to back you.
No, they have, but the increment. It's all about the increment. It's all about what happens next.
No, but the increments don't back you. They just don't. The data is that people are had a great 2022, and they're probably going to carry on with that way. But
I don't know. Like data is this,
Well, put it this way: am I an outlier? Or put it another way: what would cause the most blood for the stock market in the next year? Blood. Like Citadel has a shitty time, even gets challenged. What would that be in terms of what the stock market does?
I mean, the hardest thing, for Citadel, the undoing of Citadel is kind of like the art of seduction. If people weren't entranced by stocks or by risk assets, if people were inactive and did nothing, if people were just like, oh my God, I just don't get this market, but I'm just going to do nothing. Citadel and others have become the system. And Citadel benefits enormously just from buy, sell, just activity. Right?
Zero trade date to expiry stuff and everything, all these games. Okay, lousy choice. But in general, MetLife. How about Harvard Endowment? What would cause the most grief and pain and suffering? It's not if the market drops. It's certainly not if the Fed actually drops inflation. It's certainly not from these current values being justified in terms of what happens over the next year. It's not in terms of the popular view of what GDP is doing, are going to do.
So what is it?
What will cause the most blood is if the market soars about 20%. A lot of people will be destroyed. In fact, I would say the majority be destroyed. The only hedge, if the Fed is not a factor here, as startling and radical as that to be, but I can't find the flows. I can't find the reaction function. I cannot find where the rubber hits the road in terms of what the Fed is doing or can do. So if the Fed's not involved, the only hedge for inflation, if it's going to stick around for a while, is equity. That's the whole basis of modern portfolio theory. That's the whole basis of the balanced fund. It's equity. So if you're not long a lot of equity, or a reasonable amount of equity even, you're going to really suffer.
I mean, tell that to the equity folk that went through the 1970s, because the theory is, you're right. The theory is correct. The problem is in the wind tunnel of the markets. What happened in the 1970s? You were in a range, and you ended up, when we went to 600, we were going to crash, and you sold. When we went to 1,000, I'm making the
I wasn't working then, but Hugh, I did work from 1981.
But you read the books.
2012.
Yeah. People, the biggest people were the institutions, the equity institutions were the biggest sellers of equities during the inflationary period of the 1970s. Why? Not because of the theory, because people try too hard.
If my experience has any bearing, you don't make money by being with the pack. You don't, in fact, you usually end up with a lot of pain.
You certainly don't make money like you certainly don't make money like with FOMO rallies and like buying equities because they're going up.
I don't think I'm talking about that. I'm talking about dislocation between the economy, reality, and perception. I've never seen it so out of whack. And I've never seen such confidence that people feel the economy is doing shit or it's about to do shit. I've never seen this. There was always a debate. Now there's no debate. It's a done deal. It's a given that a lot of people are even saying that we already had a recession. I don't know. I missed it. I don't know what you saw.
I see different things from you as we've established, but that's what makes a market.
Okay, I gotcha.
But I like ending on that tribunes of blood that you were referring to.
That's kind of.
I'm not a tribunes of blood, but I like the colorful metaphors. George, I want to thank you for your patience. People will be watching this going, "Oh my God, that Hendry is just tedious, and he just won't let our wonderful guests elucidate further." They're all there saying, "You're telling me more." You're right, George, because the market is certainly presently pushing in your direction, and it's fascinating.
It's not even going to be approaching my view until it hits 5,000. Otherwise, I'm just a windbag. But if we see 5,000, 5,500, 6,000, then you're going to say, that's what that guy was talking about.
That's what he was talking about. That's what he was talking about.
That's what I'm talking about.
From one windbag to another windbag. I mean that in the nicest possible sense, but
4,300 is nothing in terms of the context of what I'm talking. I'm saying we have no Fed. We have no active Federal Reserve now. It's just not operating.
Well,
and you can't find any sort of.
But it hasn't been operating for a long time, and for me, it's the system has been dictated by the ghosts in the machine, which are largely unrecognized.
We probably agree on that. I see the whole thing stopped in 2012.
Kind of that period. Yeah, that period.
Yeah. Very good.
Wonderful. Thank you so much, George.
Okay, sir. Okay. Thanks for having me. A big compliment.
Oh, a pleasure. I'm sure the folks are going to love it. Thank you.
Okay, bye-bye.